Okay, I think I'm recording now, so we can kind of get started here and take a look. Who are we missing? Who's Michael and Alex? She'll probably be late. And then who on your? Garrett. Where's Garrett's wrestling gone? They shouldn't be, because they wrestle here this Thursday. They wrestle here Friday.
Wrestle at the high school.
Right, on Friday, because divisionals is on Saturday at the high school. So, yeah. So announcement, yep, we have wrestling this Friday. It's going to be at the high school as opposed to here. They kind of did that on purpose because the high school divisionals is the next day, Saturday all day. It should be kind of fun. Although I would, if I had to make predictions about the high school wrestling outcome, I think I would be pretty accurate maybe. I think Havre for the divisionals will probably win going away. But all right, so I have processed the round, but I have not plugged in the numbers yet to see who the victor is, and I don't honestly know. Usually I can tell if I kind of look at the results and just kind of, but I don't know. There could be some penalties and stuff that I haven't seen yet. Just the score itself, the raw scores, may be close enough that I can't tell. So we're going to do some plugging and see what happens. I'll show you guys kind of my process. So I got to get to round 2. Sometimes this first one, for whatever reason, takes a while to work. I will make a prediction that it is between teams Baldwin or teams Andrews and team Digby would be my prediction, that it will be one of those two teams that is likely the victor. Arm quit working?
No, I was trying to put a little park, but my ears are all iced up. It says make things a little difficult. Yeah, but I had no ears and no windows.
They make scrapers for those.
Oh, yeah. Yeah, nah. I like the challenge better.
Okay, here we go. I think I've got the numbers plugged in. So you guys want to see who won first, or kind of go through the round a little bit first? And well, let's go through last week's assignment. Let's do that first, and then we can come back and see who won maybe. So, all right. Last week's assignment. I've got my answers here. I haven't corrected. Obviously, you guys, it was just due today, so I probably won't have them looked at until Thursday at the earliest. But this will give you an idea what my answers are, so it'll give you an idea then of what you should look for. Okay. I'll be doing this regularly in this class, and your assignments are due this morning, right before class. So there's not going to be a lot of tolerance for late assignments in this class. This, out of all the classes I teach, this one's really hung up on a schedule. So you got to get things in on time or suffer the consequences, I guess. So, okay. First question, I've got ROA is equal to net income divided by total assets. Do we want this ratio to be higher or lower? We would prefer a higher ROA, all things considered. So, B, in what two ways can we improve the ratio? And I ask you to just think simply, or think simple. A, you can increase profits, and B, you could reduce your assets then, right? If you reduce your assets, you're making the denominator smaller. If you increase your profit, you're making the numerator bigger. Either one of those is going to improve that ratio. So, okay. Again, ROA is not necessarily, it's not something you're scored on. It's not something that I spend a lot of time looking at necessarily. I can tell you in banking, we looked at that all the time, every day. We looked at our ROA for each day, almost got to be kind of like, God, why do you do that? Because it would change by fractions of a percent, right? But it was that important, right? Okay, and it can be that important here too. It's something that you do want to try to make better. You know, you want to do the things you can, right? So it's not all just about increasing the income, although that's obviously a component of it. You can reduce your assets as well. 2, selling stock or shares, all else being constant, has what effect on ROE? It reduces ROE. Do you want your ROE to be lower? What's its effect on EPS? It reduces your earnings per share. Okay, do you want your earnings per share to be lower? One company I own a little bit of stock in is called Glacier Bank. I was a little bit miffed that they just came out with their quarterly earnings and noted that they had sold stock, issued stock this past quarter. Okay, I think it was the last quarter. It was last year anyhow. And I was a little bit upset about that because why? Because that's going to dilute my earnings. I read a little bit further, and their reasoning was a little bit better, just to give you an idea. They actually issued stock because they were buying another bank. They've accumulated quite a few banks during the years. Okay, my guess is, and I didn't read the full thing, but my guess is they had to issue stock because they wanted a tax-free transfer. If a company, if you can trade stocks, okay, you're the seller, so you end up with stock in the new bank, it becomes a tax-free thing as opposed to being bought out for cash. I'm sure that Glacier Bank probably would have preferred just to buy them out in cash, but some of the owners of the other banks said, no, God, then we're going to have to pay all kinds of taxes, right? We'll have to pay all kinds of capital gains taxes. We would prefer to get stock in Glacier Bank, and so they had to issue some new stock, okay? That's not a bad reason in that case then to issue some stock. That happens, okay? Berkshire Hathaway did that when they bought BNSF. Okay, they did that because, again, some of the BNSF folks didn't want to have to claim, you know, the capital gains and whatnot. So that's not a bad reason to issue stock. Okay, there are other good reasons to issue stock. Okay, but in normal circumstances, it's not something I would do unless I had exhausted all my other funding opportunities. How's that? 3, why did Andrews have actual sales that substantially exceeded potential sales in the low end? Just primarily because Baldwin, Chester, and Erie didn't make enough product. That's it. Okay. I mean, you could have got more specific, and if you did, that's fine. Okay. But really, the other teams just didn't make enough product. They had potential sales that were higher than their actual sales. Okay. And thus it allowed Andrews the opportunity to have greater, greater actual sales. We'll do quite a bit of math, you know, a decent amount of math during the semester, talking about actual versus potential probably. Excuse me. Assuming normal market conditions, what will be the total industry unit demand next year in the high end? Okay, math. It's going to increase under normal market conditions. It's going to increase by 15.2%. You could go to the Courier from round 1 and it would tell you that it's going to increase by 15.2%. And the demand for round 1 was 2,985 or 2,985,000. Okay, I've used it, left off the 3 zeros like they do in the thing. If you added the 3 zeros, that's fine. If you didn't, that's fine. Okay, so simply 2,985 times 1.152. Okay, that's just your 15.2%, right? Is the 1.152 equals 3,439. Probably going to round up 3,439. Can you look at round now? Given normal market conditions, there's no guarantee that we're going to have normal market conditions. But what is the demand in the high end for round 2? Anybody got that open right now for their Courier?
High end, you said?
Yeah.
Demand is 3,439.
3,439. Look at that. So we had normal market conditions then from round 1 to round 2. Okay. So there was the math. I'm not going to promise you normal market conditions for every round. So you know, we might have some ups and downs. So that's the assignment. Okay. That's the answers that I kind of would have expected. Like I said, if you expanded on some, that's okay. If you had less than this, that's not okay. So, or if you missed this, if you missed these particular answers, probably not okay. So, okay. By the way, some of these assignments, especially when we get to some more complex ones, I'll get students that catch things that I don't sometimes, and that's kind of fun. it's kind of like shame on me kind of fun, and you guys can laugh at me if you want, that's okay. But I'll get some students every now and then, they'll come up with some things that I've missed, and I like that. That's pretty cool. Okay. Is the suspense killing you? Who's Digby?
Computer.
Oh, Digby's the computer. Oh, well, geez, then it's not that much, it's not that suspenseful. I don't think so. So we'll just go ahead and have a look then. I forgot that Digby was the computer. I can't believe you guys let the computer back in. Gosh. You guys were dominating the computer in the first round. You let the computer back in. Okay.
Well, I think the computer cheats because it knows exactly what everybody else is going for, because it looks like it's the only one that pursued its strategy.
Well, I'll go back to saying what I've said though, that in the competitive rounds, I've yet to have a class where the computer ultimately won in the competitive rounds. So
because the whole class is kind of going after the exact same thing, and then
I don't think so.
Well, not exactly, but they're going similarly, and the computer's the only one really going for its market.
So maybe it's boldly pursuing its strategy,
and it's working well for it.
Oh, okay. And
it just doesn't have to
what
work
a
everybody else's.
what a concept! Boldly pursuing its strategy, man. Okay, earnings per share. Andrews was successful in earnings per share over Digby, which was second place. I can tell you though, it's only by a few cents. I mean, it was what, 697 to 692 or something like that. Okay, Andrews, I would say, made a huge error in the first round. That almost got them in terms of earnings per share. It did get them in terms of ROE because Digby had the highest ROE. Okay, same error, but on the earnings per share, it almost cost them. On the ROE, it did cost them. Okay. Contribution margin, though, Andrews had by far the bigger contribution margin. They had a huge, for this early in the game, that's a pretty good contribution margin, over 40%. Okay, over 40%. By the end of the game, I'll tell you that won't necessarily be a big contribution margin. Won't necessarily, even though your prices are going to keep falling, okay, throughout the game, won't necessarily be a big contribution margin. Stock price, though, Digby, okay, probably because Digby didn't have the best first round, their stock price probably increased more from first to second round, so they had the advantage there. Remember, that's just the increase in stock price when I look at that. Profits, Andrews did have the highest profits by a couple million, if I'm not mistaken. Cash flow, Andrews had good cash flows, followed by Ferris and Digby. So point-wise, Andrews 96.5. We don't know if they had any penalties. Doesn't look like it matters. I don't know that they could have had enough penalties to allow any of the student teams to catch up. In fact, every other team had penalties except Andrews. So that's a pretty impressive then victory, because you got 96.5. The next closest, Digby, next closest student team's about 70. So was Andrews cheating too?
I don't think Andrews is. I do think the computer probably does. I've played it in solitaire or chess, not against the computer enough.
Okay, so congratulations, Team Andrews. You guys were successful this round. Yay. Let's go, I'm going to go back and look at this, open it up in a PDF format. That seems to be a little bit easier for us to view. Maybe.
Yeah, if I wouldn't pay back so much of that dividend, I might have put that ROE a little bit better.
If you wouldn't, if you what?
I paid into that dividend, I bought stock back, and I paid into that dividend, and I think that really hurt me.
Buying stock back and paying a dividend would both increase your ROE.
Oh, I had it backwards. Okay.
Yeah, they would both increase. They would be a benefit. Yeah, your error.
I thought I had that right.
Yeah, your error wasn't this round.
Oh, it was last round.
I think so.
Okay.
Selected financial statistics. Here we go. ROS. We had a big win there by Andrews. You know, nice return on sales. ROA also big difference there. ROE though, Digby, okay, why did that happen? Why does Digby have a bigger ROE? Andrews made more profit, okay, so what do we know? ROE is net income over equity, right? Digby didn't sell stock. Maybe. I mean, you're kind of going in the right direction, but it's not for sure that. Okay. It is for sure that they have a lesser equity then, right? It is for sure that they have a lesser equity. It's very likely, because Andrews sold a lot of stock in the first round, that it's because they sold stock. But you can do other things to reduce your equity, right? Okay. You could have, Digby could have paid a huge dividend, right? That would reduce their equity because it reduces their cash, it reduces their assets. Remember our accounting equation, right? Assets equal liabilities plus owner's equity. So if you were to reduce your assets, you're going to reduce your owner's equity then too, right? So you could pay dividends. You could do other things, right? That's what financial management's all about, is doing those types of things, right? Usually financial managers aren't the people that are in charge of going out and marketing and making money in those fashions, those ways, but instead they're the ones that try to manipulate. I don't know if that's a good word. That almost sounds illegal, but you try to change and do things within your bookkeeping and whatnot that can enhance shareholder value. Okay, so. Cruising on down, leverage. Digby and Erie, big leverage. Ferris also a little bit over. Oh, Baldwin too. So there was a lot of discounts for leverage. So some teams took me to heart probably though and decided to use some debt to maybe improve their positions. Okay, yeah. It's a little bit risky. Yeah, you got a little bit penalized for it. If you're investing in the right things, it could pay off. Okay, and we'll see as we go down. ROE. We talked about that already, and the fact that they kind of flopped positions. Sales, Digby had way more sales than did Andrews. Okay, how did Andrews have more profit? If I asked you that question, that's a good question for the homework. Maybe I shouldn't. Okay, I mean, give me a one two-word answer as to why Andrews had a higher profit than did Digby, even though their sales were $40 million less. Lower costs, which, I mean, you're right, it's on the right trail. I'd say contribution margin, okay, but that's the same. That's the inverse of lower costs, lower variable costs, right? It's the inverse, okay. 40 to 31, 10% difference, roughly 9%, okay. 9% difference, 10%, I mean, that's $14 million difference, based on Andrews' sales. Granted, Digby had more sales, right? But huge difference because of the contribution margin. Now, Digby made some of that up because they've got less SG&A. They were more efficient on their SG&A. My guess is they spent similar amounts, just kind of glancing at it. They spent similar amounts on SG&A, but that means Digby was a little bit more efficient and effective in producing sales given the same amount, okay? What would be ways to be more efficient and effective? Might be a good homework question. Okay. Profits. Every team was again profitable except Baldwin. Who's Baldwin? Is that you guys right here in front? Oh, that's okay. That's right. I got to remember the blondes or the Baldwin. So, okay.
If you submit 2 decisions, does it let you submit 2 decisions?
Yeah, it's going to take the last decision saved. So if somebody got in late, okay, you guys didn't have any submitted because I sent you a note yesterday afternoon. So,
Yeah.
but then somebody uploaded them after that. So, okay. I can tell you who the last person was that did it.
I uploaded all of them.
Okay. Almost break even. I mean, that's literally a $13,000 loss on a $100 million in sales. That's really about break even. I mean, that's almost a rounding error, you would say there. So it's not horrible, okay, but it's obviously not a profit. So look at that. Everybody's got a contribution margin over 30, so that's pretty good. I mean, you guys have decided to concentrate on something that's a pretty important part. Everybody's also got SG&A and sales over 10%. That's pretty high. Okay, that's sort of bad in a sense, but maybe not, because that's one of those areas that it really depends on what your competition is doing too. Okay, so you'll be if yeah, I'm not going to talk about that because it might give away some of the tactics and whatnot that a person might do. So, okay, cumulative profit I don't spend a lot of time on. Ferris was barely profitable, $616,000. Okay, who's Team Ferris? It's you guys. Okay, so you guys are Team Erie. Okay, $2 million. Chester still had $6.3 million, but Andrew's the clear winner amongst the student teams. 23% Digby has in terms of market share. So again, pretty good sales there. We'll see how they did that. Maybe we'll take a look. It's good. I can use them as an example without worrying about upsetting them or anything. So our stock market summary. I kind of like to look at the graphics. You know, the Team Baldwin kind of went south a little bit. These two teams, Team Erie kind of just stayed even. Team Ferris kind of a steady down. We see Chester had a nice up and then a down. Digby and Andrews both kind of pretty straight line to the top, so that's pretty good, right? Digby sold because the first round they didn't have any additional shares outstanding, but they sold 50,000 shares. A little bit of a surprise. The fact that it's the computer team, they're going to do what they're going to do, right? So, market cap, Andrews is actually the bigger of the companies, so its stock price is probably higher. Yeah, Andrews has the higher stock price. You can see that in the chart. Here's the earnings per share, 667 to 662. Yeah, so Andrews won by 5 cents. So, yeah, I knew that one was really, really close. Even though you're about $2 million ahead in profits, the earnings per share, because 350,000 additional shares outstanding versus 50,000 additional shares outstanding. So 300,000 additional shares, that's huge. That's 15% from what we started, 15% additional. So, that's why there's such a difference there. Huge things to look at. Bond market summary. We see some teams using some debt. I would say Team Erie got after it pretty good, and Team Ferris as well got after it pretty good. So it'll be interesting to see. This is one of those, again, I glance at because as I'm scrolling down, I start to go, Erie borrowed a lot of money. Okay, I need to know. I'm going to have to know as I cruise down a little bit further. I'm going to have to know what they borrowed money for. Team Ferris borrowed a decent amount of money. I'm going to have to know what they borrowed money for. Digby, to a lesser extent. Baldwin kind of looks like they paid some back a little bit and then borrowed a little bit more. Am I right there? Talking to you guys, yes. Okay.
We dropped to a triple B.
Andrews triple B. That's the best rating on the board. You guys are the only investment grade out there, so.
So triple B is better than double B or
Yep.
single B?
Yep.
So they're
Triple A is the best. Okay, Triple A is the absolute best. Like I said, there's only about 3 or 4 corporations in the whole world that have a Triple A rating. The United States of America does not have a Triple A rating anymore. Okay, we did up until a couple of years ago. We're at double A minus or something like that, double A plus or something. What's that? No, we're close to still at AAA, but just shy of that. But there are a couple of corporations. J&J is the only one that I know of. What's amazing is you take a company like Apple that's got over $200 billion in cash on its books and hardly any debt. It's got some debt, but hardly any, and they're not AAA rated, right? Which is a little bit astounding. Or at least I don't think they are. We could sure look that up. Somebody want to look that up for me? Apple's credit rating. Might get you there. Okay, our net income, our depreciations, Erie. Yeah, I got to check Erie out. Okay. You know, remember they borrowed some money. I saw that up above, and now they've got more depreciation than anybody else. Baldwin's got quite a bit of depreciation, though, as well. More so than Andrews. A little bit surprising there. Okay. Accounts payable, I don't see anything huge there. Inventory. You know, everybody had, okay, as I look at this, with the exception of Ferris, and Ferris had just a little bit of change. What's it mean when everybody except Ferris had negative cash flow due to inventory? What's that mean?
It means we had inventory left over.
That means, yeah, your inventory increased from round 1 to round 2. Okay? So just glancing at that line, I can look at it and I can say, ooh, inventory was a bit of a problem this round, right? Because we had an increase of 15, 42, 48, plus 8, so 56 million roughly in inventories as a class. Okay, so I can tell, you know, something's wrong. I'll bet you when I go down and I look at that production analysis, we're going to see a lot of inventory in the one column, second or third column from the left, right? Okay. Accounts receivable, we had some changes there, and they're for the most part positive, except Digby, Erie, and Ferris. I guess Chester's was mildly negative too. So Andrews and Baldwin, I guess, were positive. So they had positive. What's that mean? They had a positive cash flow. Remember, we're looking at the cash flow statement up here. So they had positive cash flow due to their accounts receivable. Okay, so they actually reduced their accounts receivable outstanding. That's kind of interesting. Okay, plant improvements. Oh yeah, we had some. You know, I had the depreciation up here, and I had the borrowed money with Team Erie, big borrowing, and 34 million in plant improvements. So, you know, bang bang, walla walla bang bang. I'm starting to take a look, saying, ooh, they spent some money. I'm going to have to know. Baldwin, 37.4 million in plant improvements. Unfortunately, they financed a lot of that with an emergency loan. That would be. What's that? Okay. You know, that would be the negative, but they made some plant improvements. You know, as a competitor, I got to know. Andrews not so much, and Ferris not so much. Chester and Digby kind of in the middle, so I might kind of want to take a look at what those teams did as well. Dividends paid. Interesting. There's 3 teams paid dividends. Andrews paid a big dividend. You know, for this part of the game, that's a pretty big dividend. So. Now this is now I'm going to tell you that this is Andrews sold stock and bought back stock. Okay, and there was a net difference there. They actually sold more than they bought back. Okay, and I'll really pick on Andrews here. They were the winning team, so they can take this with a grain of salt. But they just spent a lot of money to exchange money. Okay, they just paid a whole ton of fees. Just to exchange money, okay? Because you bought back stock, so you're buying it back. You're reducing your shares outstanding, but then you issued some stock. All you're doing is paying investment bankers. They're loving it. They're sitting back there. That's why they have yachts and crap, and they live in New York, and they smoke cigars and drink cognac, okay? Because you got Andrews that's both buying and selling stock at the same time. Love you guys. You know, if I'm an investment banker, just love you guys. So I'd take you out for lunch and 3 martini lunch. And, you guys go back to work, and I'd go home. I'd go home and take a nap. You guys go back to work. Yeah. Okay. Again, I'll pick on them since they won. I'll pick on them big time. So, and debt issued. Ooh, Erie got, and we saw that from up above, right? We saw it up above in long-term debt, retirement of current debt. Drain on cash, right? That's why we see the negatives there. Okay, and then the emergency loan. We had a couple of emergency loans. Both Chester and Baldwin had an emergency loan, so obviously they don't have any cash. Digby, this would be scary. Okay, a little bit. Our computer team's sitting on all kinds of cash. Now it's poor cash management by Digby. Really poor cash management, I think. You know, having that much cash on hand is okay. You know, Erie and Ferris, that's a reasonable amount. Baldwin and Chester went the other way. Okay, that's poor cash management as well when you got to take on an emergency loan. Andrew's sitting, you know, reasonable amount. Okay, you always want to have a cushion. You know, I mean, would it be nice to come in at exactly 0? You know, in my opinion, that'd be like perfect, right? But I'd rather have a cushion though too, because you're cutting it pretty close if you're sitting there at 0 all the time. And accounts receivable, we see some numbers there worth looking at, but inventory, we're now in the balance sheet. I'm sorry. Okay, we've gone from the cash flow to the balance sheet, so we're kind of changing a little bit. Inventory, we set up above. We knew that there was going to be some big inventory numbers, and we see that. Ferris, while they had an actual increase in cash because they drew down their inventory, they still have a ton of inventory, right? So what's that mean? Ferris had a lot of inventory coming in from round 1. Okay, yeah, they reduced their inventory outstanding, but not by very much. So they had a bunch of inventory coming in from round 1. Okay, it's kind of nice. I don't have to go back and look at round 1. I can tell that just by glancing at this then, right?
Would you sell out of your inventory?
Mm-hmm.
Like, not out of it, but sell from it?
Right.
Are your labor costs in the previous round?
Okay, the question was, if you sell inventory, so everybody's going to have some inventory. You do, because it's listed here, going into round 3, and it's a last in, or it's first in, first out. I'm pretty sure is how the game works. So it's first in, first out. So you're going to sell your inventory before you sell your current production. Okay. Then the question was, what are the costs based on? Are they based on this year's production, or are the costs based on last year? Okay. When we're doing accrual accounting here, when do your costs get recorded? They get recorded in the period of production. Okay, they should be. So your costs for the production should have been recorded. I think I'm wrong about that. I'm sorry. Your costs are going to get recorded in the period of the sale, but they will be based on last year's costs. Does that make sense? Okay. Your costs actually get recorded when you sell that product, but it's based on your labor and materials numbers from the round they were produced. But it doesn't get recorded until the period that you actually sell it. Okay, it's cost of goods sold.
Okay.
So it gets recorded in the period that you actually sell it, but it is based on your prior years. Okay, prior years numbers.
So if our inventory is made in the prior round, it's going to be behind, right?
If your inventory is made in the prior round and you've done a lot of stuff to cut costs for this round, yeah, that's going to have an effect. That's why when you start figuring contribution margin, you know, if you've cut your costs way down here, it never, we can look at that when we get to the production analysis. It doesn't seem right because, oh geez, you know, my contribution margin should be 35% based on my costs, but you have to go back to the prior round, yeah, and use those costs.
Is there any way to like get rid of your inventory?
Is there any way to get rid of your inventory? Sure.
Aside from this,
Lower the price big time. Okay. Your inventory is going to be the first thing sold anyhow. Okay. So the best way to get rid of your inventory is to adjust your current year's production, right, to reflect the fact that you had a bunch of inventory on hand, okay, and based on your sales forecasts and all those other things. Okay. Keeping in mind that we're in a rapidly growing industry though too, right? We're growing across the industry at what, 14%, something like that, across all industries, across all segments, I should say. Okay, does that make sense then, how to get rid of your inventory? But your inventory is going to sell first. Right.
but why is that if they're at not the position the customers want?
What if it's not positioned? The customers, I think the way the game reads, this wouldn't be necessarily this way in real life, but the game reads that the customers are going to assume that the product is the latest rendition. Okay? So it's going to allow you to sell your inventory as if it was a new product, but it's going to be based on the old costs. Okay? If you looked at we might look at that when we get down there. Okay, so, you know, fixed assets, again, I kind of like to look at these because, you know, I asked you a question about return on assets, right? I like to look at total assets, I'm sorry. And we got a couple companies here, Digby and Erie, that are quite a bit bigger right, in terms of assets. Now, if they've got a lot of debt, their equity isn't going to be that much bigger, and it's not. Okay. Now, what's amazing is you look at a team like Team Andrews, right? They've got not that much in terms of total assets, but they've got the biggest, by far, amount of total equity. Ooh, okay. Is there a reason that they didn't win the return on equity? Yeah, they've got more equity than anybody else, by far. Okay, partly because they sold a lot of stock to begin with. Okay. But, we could take a look at some other things. They probably got less debt, current debt. Yeah, they got less debt, a lot less current debt. It's payable, long-term debt. They're towards the lower end in terms of long-term debt. Okay. But they're at the very top, right, in terms of common stock. And they're also up there because they've had the best earnings. They're up there in terms of retained earnings. And they're 15 million more equity than any other team. So sales, income statement, variable costs. Again, I'm more concerned about the contribution number there, contribution margin number. Depreciation, we looked that up above in the cash flow. SG&A, remember I said I thought that Andrews and Digby probably spent a similar amount, and they did. Digby spent a little bit less, but not much. And Digby was far more efficient because remember their SG&A to sales was only 10%. Andrews was 14%. Okay, why do you get efficiency and effectiveness in your sales and promotion? Are you allocating it better? Yeah, maybe you might be getting a little bit there, but there's probably some other reasons that are a little bit more important. That won't be meaningful until we get to TQM, really. Earnings before interest and taxes, as you might expect. Interest, you'd expect that the teams that have been borrowing, Erie, Digby, would have high amounts of interest, right? And they do. Baldwin, of course, Baldwin's was up there. Why? Why was Baldwin's interest so high? Emergency loan, yeah. Yeah, you pay fees, and you also pay a higher interest rate when you take out an emergency loan. A little bit Chester too, but their emergency loan is quite a bit smaller. So. A little profit sharing, net profit. Okay. Team Digby, which did pretty well. Our computer team is the only team that's really starting to use some capacity. Okay. Overall, there's still way excess capacity. Okay. Team Digby starting to use some. You could argue Chester and Erie, but nah, not really. Okay, so Team Digby's the only team, and they still got a long ways to go. They still have. I would tell you that Team Digby still has a lot of excess capacity. Lots of excess capacity. But you don't want to pay that overtime, right? Inventory, we said that there was a decent amount of inventory, and you can just kind of go down that, that column, and you just take a quick glance and you see, yeah, there's a decent amount of inventory. But it's kind of all over the board. Different teams did well, it looks like, in different segments, as you might expect. In the low-end segment, for example, Ebb and Feet, Feet sold out. Well, that's not surprising. They didn't make a bunch. Okay, they had the highest price. Okay, so I'm starting to assume a few things about Team Ferris and what their strategy is. Okay, Ebb sold out, low price, lowest price looks like in the low end, sold quite a bit. Okay, Dell sold the most and didn't have the lowest price. I'm going to want to know why Dell was able to sell more, even though quite a bit more. 600,000 units more, thereabouts, 550, something like that. And they didn't have or did they have? No, they didn't have the lowest price because Bead had a much lower price, but still had quite a bit left in inventory and they sold 1 million units less than did Dell. Okay, I probably want to know why.
Well, they're not here, let's figure it out.
Who's not here?
Dell.
Yeah, Dell's not here. Baldwin is. Okay, we'll get down to the low end, remind me, and we'll kind of take a look, and maybe we'll see if we can piece it together a little bit. Andrews did a nice job in the low end because look at that. They got 31 units of inventory. That's just about selling out. Highest price, okay, highest price, lowest cost it looks like, and maybe not quite the lowest cost, no, but pretty low cost, and nice 47% contribution margin. Ooh, Baldwin, we said, you know, they spent some money. We saw that up above, right? Got to take a look at what they spent money on. Erie spent quite a bit of money. We need to take a look at what Erie spent money on. Okay, I can tell you what they spent some money on. Erie actually added some capacity, got rid of some capacity. Okay, cool. Okay, I'm glancing at this. I'm not going through everything, right? But I would be spending a lot of time on this particular report and looking at different stuff. I'd want to know what my competitors are doing in terms of capacity. I would certainly want to know what my competitors are doing in terms of automation. Okay, watch their costs. Again, an investment in automation might not show up until the next round. Different things like that. You know, I'd really start looking at that. I'd start looking at the age of those products, right? Okay, I think when we get down and we look at Dell or Digby versus Baldwin in the low end, okay, we might see that age might have been a big factor there actually. Okay, and we'll take a look at a few other things. The coordinates are kind of important. I'd be watching the MTBF. Okay, I'd be watching that very, very closely. Oh, that's interesting. Yeah, that's really interesting. Huh. Wonder why they do that. Okay. Everybody kind of matched up here. That's kind of cool. Everybody's potential and actual means that probably everybody had some inventory left over in the traditional segment, would be my guess. I can come up and take a look. Inventory. Everybody had a little inventory left in the traditional segment, so everybody's potential matched their actual. Okay. And not a huge disparity. Team Digby did the best. They're up here at 20%, but the worst is, still at, 14, 12, 13%. So somewhat significant. Looks like that's interesting. EAT, is that the...
That's traditional.
That's traditional, and then you've got another traditional product in there?
Yeah.
Okay, must just be the way the colors are looking. This sometimes in the smaller map I can't really tell. So your EAT product is about to leave the traditional segment though, so that's kind of interesting. That was, if I'm a competitor, I'd be taking a look at that, trying to figure out what's going on. We were going to take a look at the low end. I'm going to jump down to that instead of spending all my time here in the traditional segment. Everybody had inventory, yep. Low end, and look at that, wow. Erie had even more potential, okay, lots of potential. They gave up quite a bit in the low end. Okay, that'll be a good question. I'll ask that question on your homework, something about the potential versus their actual there. Okay, we'll start kind of the math thing there. Ferris looks like, they don't really care too much about the low end. Andrews maybe not so much either about the low end, interestingly. Baldwin had a little more potential than they had actual. Okay, but why did Erie have such greater potential than Baldwin? Digby had better potential than Baldwin. Digby had, we talked about their sales. One of the reasons, I mean, it's pretty obvious now, one of the reasons that Digby had more sales than Baldwin, while their potential was still greater, it's obvious that they made enough, whereas Baldwin didn't make enough inventory in the low end, so that's part of the reason there. But their potential was still a little bit greater, but Erie had a far greater potential. So let's go take a look, though. So Dell was the biggest seller, okay. Boom, 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 boom. 21.5. Their price was not the lowest. It was kind of middle of the pack, though, right? Okay. Is price a big deal? Yeah, price is a big deal. So they were kind of middle of the pack. You would expect that some of the lower ones would be more important, okay, and maybe. Okay, MTBF, everybody's got similar MTBF, although Acre had a higher MTBF. They were at the very top of that, even though that's not at all significant, really, in the low end. Okay, what happens when you raise your MTBF in terms of costs?
Go up.
Costs go up. Okay. Okay. So we were looking at Dell, maybe specifically as compared to Bead. Bead had the lowest price. Okay, $20. So they should have sold quite a bit more. Okay, but their age was 3.41. Is a young age always the best?
No.
What's the optimum age for a product? 7. Okay, and so theirs was younger. I'm gonna pick on Bead a little bit. Put on your armor. Okay, get ready. Bead moved their product backward.
It wouldn't let us move it.
Well, you did move it. You moved it in the wrong direction.
Tried changing the numbers and it wouldn't change it.
Ah, okay, I know what happened then. I'll tell you what happened here in a little bit. Okay. So Bead's product ends up being back here, okay, quite a ways. So they moved it backwards, and that actually made it younger. They didn't move it backwards, but we'll talk about that. They did in the first round then, okay, and so it made it younger. They spent some money there. Dell spent quite a bit more in promo and sales too, though, right? Quite a bit more than any other team, really, other than Acre. Acre spent the most down there, okay. But Dell spent quite a bit, had a good price, different things like that. Okay. Acre had a good contribution margin. So, I mean, they spent a lot, but they had a decent contribution margin. So they made some money on their sales, even though it's quite a bit less, half of what Dell's were. It'd be interesting to see which team made the most money on that then. That would take some decent math, because you'd really have to go back to the last round, compare your costs, do some things like that. So that one, you'd need a little small spreadsheet to figure that one out. So we probably won't get that in depth. So what happened to Bead? Why is Bead back here, and why weren't they able to change it? Anybody know?
Because it was too revising.
They made their revision too far out in the first round. Okay, they moved it too far in the first round. Must have, is my guess. Okay. Yep. You can see that that's going to happen to Eat in this next round. Okay. If you make your revision more than a year out, okay, you are safe to go up to December 31st of the end of the next year. If you go to January 1st, one day more, then your product won't revise at all, okay? And your customers won't like you either, okay? So you really have to watch that when you're making your R&D decisions, as you're making those decisions, and especially like in high end, high performance and size, okay? Because you want to be aggressive, you want to be out there on the front end. And if you fall behind a little bit here early and you work too hard to try to catch up, you can make a decision that'll get you out there too far, and then you're stuck, because the next year you won't be able to make a decision on that. Okay? And so that's my guess as to what happened with Baldwin there. So, okay. So lesson learned. That's why we have some practice rounds here. Okay. Okay, we're at ideal age, ideal position, yeah. Okay, high end, interesting competition going on there. Again, everybody had inventory, must have had some inventory left over in that. We see Andrews, pushing that. Digby to a lesser extent, but significantly. Okay, other teams competing. Baldwin, maybe not so much, right? So I'm starting to try to figure out. We've got 2 rounds. I'm going to start trying to figure out what strategies are for the various teams. I should be able to do a pretty good job after the second round. I should be able to get kind of close. Okay, if you guys are really pursuing your strategies, doing a really good job of pursuing your strategies, I should be able to nail it. But maybe that's not the case. So. high end. That MTBF's kind of all over the place. That's kind of interesting. Huh. That is kind of weird. So Andrews actually increased the MTBF of their low-end product and decreased the MTBF of their high-end product. Performance, again, everybody had some inventory left in there. We got Digby's dominating in that particular case. We're going to look at the perceptual map, the bigger one. It'll maybe give us a little clearer look at some of those things. Size. Now, little differences in there. Andrews and Digby are two main competitors there. And I'm skimming through some of this stuff that you guys should take a look at. So our potential, versus actual, again, look at the real numbers down here. And occasionally you're going to have two products, in one segment, like Baker and Bead, both sold a little bit here in the low end. Okay. And their potential was 0.2 and 17.3. Their actual for Baker was 0.2, so there wasn't any difference there. Sometimes I'll ask you a question and you're going to have to sort out that there may be two products in there. So their potential, though, for their bead was 17.3. Their actual was only 15.7. So they gave up 1.6% of the market share. Okay, not a huge deal. Yeah, but it's significant. What's the low end? What was the total? It's right up here. Industry sales were 11.1, so they gave up 1.6. So they gave up selling 160,000 items, something like that, if my math's correct. Okay, which is significant, $20, Could have bought lunch for a bunch of people. Okay, Digby is our computer team. What's their strategy?
Maxing production in every segment.
No, that's not their strategy. That might be a tactic. What's their strategy? I can tell just by looking at this. Can you guys? Differentiation. They're for sure differentiation strategy. Okay, there's no question. Now, they might be life cycle differentiation. That I don't know. I don't think so. I go back and see if they're introducing some new products. They might be. Take a look. If they are, they might be life cycle. They might be broad or they might be niche. I can't tell that for sure yet either. Okay, I can't tell for sure. If I went back and looked at the production analysis, I might get a better idea of that. Okay, but they're for sure a differentiator. Okay, now I'm isolating maybe to see. Okay, it's going to be important for me to know too if they're a niche differentiator. Okay, if they're a niche differentiator, they're going to start turning loose of these a little bit. I'm guessing that they're not, even just looking at this. And why is that? Because they've moved that product, or they've kept it very relevant, that traditional product. And if you were a niche differentiator, you wouldn't care. Okay, you wouldn't care so much about the traditional product. You'd probably let it slide, try to make it a cash cow. You'd be busy introducing some new products on the front end. So my guess is they're a broad differentiator or life cycle differentiator. And again, I think the traditional one would be moving backwards if they were life cycle. So I'm going to call them as a broad differentiator. Do I know? I could look it up. I haven't. So I'm just going by kind of what I'm viewing. You guys should be doing the same thing, and you should be doing that with some of your other competitors as well. Okay. There's some things that you can look at both in terms of this, right? I can kind of glance at this and I can say, Ferris, I got a reasonably good idea what they're doing. Okay. And some of the information that's up above, and you start putting two and two together, okay, and you probably get a pretty good idea then what's going on with the strategies of the teams after the second round. Okay, you may not nail it perfectly, but you should be able to get whether they're a differentiator or low cost. Okay, fitting the rest of it together may be a little bit more difficult, but you could probably do that. Okay, I'd want to know. I'd write it down, okay, because knowing what my competitors are doing and having that ready, okay, it'd really help me make decisions in certain segments, absolutely, okay. So I'd write it down what my guesses were, and I'd keep that. I'd adjust it as necessary. If the third round something comes up and goes, ooh, okay, that's a little different than I expected, I'd certainly make some adjustments. But boy, I'd be writing it down after the second round what my suspicions are. I don't tend to look at this too often. It's a nice way to compare where they are, performance and size, those types of things, I guess. But I don't tend to look at that a ton. The HR, what I'll focus on here is I'll come down to the productivity index. Okay, and only 2 teams. We had some teams that spent some money. Digby spent some money, but they didn't affect their productivity. Whereas Andrews spent some money and did affect its productivity. And Ferris affected their productivity as well. Okay, and so, you know, where was the money spent to affect the productivity? It's good to know. Okay, 1.5% again doesn't sound like a lot of money, but there, I would guess that in Andrew's case, their labor cost was probably in the $50 million range. Okay, and they could look at their annual report and tell that. You guys wouldn't be able to look at it and get an exact amount, but you could make some estimates like I just did. So 1.5 or 50 million, and they saved 1.5%. So they saved $750,000 in labor costs. Okay, by that investment. Now, not only that, okay, next year they'll save 1.5 if they don't do anything else. Next year they'll save 1.5%. The year after that they'll save 1.5%. The year after that they'll save 1.5%. And guess what happens to your labor costs too? They go up every year, right? So the 1.5% or the 750 is going to grow, presumably, right? Presumably your labor costs go up. So that 1.5% savings is going to grow if they don't invest anything else. Okay. TQM will start round 4. Kind of anxious to see that. Annual reports, ooh, that's interesting. I didn't know that showed up on the PDF version. So that gives me access to everybody's annual reports, but I'm not going to go through those because that's something that you guys don't get to see of your competitors. You guys can see your own annual report, but I'm pretty sure you're not allowed to see your competitor's annual report. Gives you a little bit more detailed information. Okay, it's important for you to look at your own. Would it be nice to be able to look at your competitors? Yeah, but you won't quite get that opportunity. So you get the information that they have up above in the courier. That should be enough for you guys to make good decisions. Any questions? As the semester goes on, my little talks will become probably less lengthy and less lengthy and less lengthy, but as it's early on, I'll spend a little bit of time, even though you guys' eyelids are getting droopy and stuff. I don't know why. You guys don't get up at 6 o'clock and make your coffee and get things going and fire it up a little bit and go for a run, get a little exercise in, huh?
Drink coffee, not run.
You don't drink coffee and you don't run. Man, that's a shame. Yeah.
Drink lots of coffee, I don't know. Sit and spin.
Any questions about the round 2? Okay, I'll try to before Thursday. I won't promise that I'll get round 1 assignments corrected, but I'll try to. And of course, I'll have an assignment for round 2 for everybody except Team Andrews. Team Andrews gets an A for round 2. The rest of you, sorry, you're going to have your work cut out for you to get your grade back up there by doing a good job with the assignments and whatnot. So, nothing else? Okay, you're free to work on your teams if you would like to and do those types of things. And of course, Thursday you'll have some time as well to work on those. We'll talk about the assignment, of course, on Thursday and a couple other small things, but